and welcome to the afternoon session of the Standard Chartered Global Conference 2022. I hope that everyone here in the room with us in Dubai has enjoyed their lunch. I know I certainly did. We're going to meet all of our panelists, and I say this because we actually have a bit of a cross-continental situation going on in just a moment. First of all, who's in the room with me? Eric Robertson, who you met earlier today for earlier panels. Eric is a chief strategist at Standard Chartered. We're joined by colleagues and clients over in London. I'm very pleased that we want to meet them. And I just get them to, hopefully they're there, to hear us by the wonder of technology, all the way over to Edwin Gutierrez, emerging market sovereign debt at Aberdeen Asset Management. Perhaps, Edwin, you can give us a wave so that not only the people in Dubai know you're there, but also all of our global audience as well. Thank you. We also have Christopher Watson, Senior Project Manager at Finisterre Capital. Chris, hopefully you are listening to us. There we go. Thank you very much. And Kaushik Rudra, who I've worked with many times, Global Head, Fixed Income Research and Head of Asia Research for Standard Chartered. Hello, Kaushik. How are you? Give us a wave. There we go, absolutely brilliant. We've got an interactive panel happening in London and here in Dubai as well. So look, let me just give you some context to this conversation. You saw the title, you felt the drama of the intro there. Of course, the Russia-Ukraine crisis is giving us all pause for thought. Volatile oil prices, higher inflation, weak growth, these are all factors that we are having to consider as we look at the economic scope for 2022, and it's become less than clear. But for the brave and the bold, there could be some opportunities here, in fact, many opportunities. And as you will hear later, also potentially for the patient among you. In fact, 2022 could even spurn talk of new orders, a new way of thinking, a new way to approach global challenges. And these are some of the things that we'll cover over the course of this conversation. I won't be the only one coming up with the questions today. I have with me here my trusty iPad, which I want to show you all, because we have, as you know, this online system that allows our audience all over the world, as well as you in the room and those in London as well, to post questions during the session. So if you hear from our panelists and you have something that you want to hear more about, and you have a burning question of your own, please do get involved. I'm going to judge the success of this panel on how many of you put those questions to us. Please don't hesitate. Tell us who you are. We would love for you to be a part of this. You are the core element of what makes these conferences happen, and your feedback is so important to us. So do get involved. With that, I want to get us started. You've heard my preamble, but Eric, you know, we have worked together virtually over the last 2 years or so. And in the most recent conversation that we had, we were talking about the economic outlook for the second quarter outlook for 2022. And you told me how it came to be known, this report that you produced in the strategy department, Recovery Disrupted. But that was a result of a bit of a debate. And I'm quite curious what the genesis of that debate was and what are the key trends that you're focusing on for this year?
Yeah, sure. Thanks, Manisha. Look, the good news is that coming into this year, we felt like there was meaningful progress being made in terms of the recovery globally post-COVID. Now, yes, there were still pockets of weakness and still pockets of challenges, but there really was a feeling that we were moving back to a sense of normal, both economically and in financial markets. The challenge is that, as we all know, we've had a military conflict arise. And in many ways, the Russia invasion of the Ukraine has exacerbated a number of the challenges that were already in place, whether it's supply chain difficulties, the prospect of inflation, food and energy insecurity. And so that has really disrupted the economic recovery. And in some places, it's halted it in its tracks. Now, from an investment point of view, the approach that we've been taking for the last couple of years, and in fact still plays a key part of how we think, is that it's not just good news or bad news. We're creating this world of the haves and the have-nots. There are those who can take advantage of some of the trends that are in place, whether it's commodity exporters, oil exporters, et cetera. And there are obviously those who are being made much more vulnerable by the current set of circumstances, food and energy importers, for example. So when we think about the investment implications for what we're seeing in the world today, yes, there are enormous challenges. Central banks are tightening monetary policy. We have the risk of a material slowdown in China, food and energy volatility. But we do think that there will be opportunities in emerging markets from both a valuation point of view and also for those who can differentiate.
Okay, and Eric, just because I want us to bounce off a low, we've talked about deflation, haven't we? How intense is that risk?
Well, I think if you think about the inflation-deflation spectrum, we went from a world pre-COVID where deflation was the risk for virtually everybody. And over the last few months, we've gone into a world where inflation, to varying degrees, is everybody's risk. And what I would argue is that the next 6 months are going to become absolutely crucial for seeing how much we fall back towards somewhere in the middle of that spectrum. The risk for us in markets, as well as for the central bankers, is that inflation does come off in the second half of the year, but the new steady state is still a lot higher than we were used to a few years ago. And I think that's what markets have started to come to grips with. Okay,
I feel like we're also in an adjustment phase as well, because there's, as we all know, so much happening. Let me take it to London. Kaushik, I'm going to put you to the test now. You focus on emerging markets, right? And I suppose, obviously, it's been a very tough year. Eric has talked about the haves and the have-nots, and we're seeing examples of that very much in the markets that you focus on. So let's extend on that. Let's talk about, for example, China's zero-COVID policy, sanctions on Russia, and also this continued post-COVID cleanup. It hasn't, we're not past COVID in many parts of the world. So with all of this ongoing uncertainty, what are the things you're focusing on?
Misha, can you just repeat that question, because part of the question got lost. We didn't really hear that.
Forgive me, it's here in the room who heard everything. But it's basically asking you how emerging markets are responding given China's zero-COVID policy, the sanctions on Russia, and that the post-COVID clear-up isn't over for a number of the territory you cover.
No, I think that's, for emerging markets, it's a very tough phase. I think we came into this year, emerging markets were sort of, about to sort of turn the corner and start seeing a period of stability where growth comes back into the markets, as well as, start seeing some normalcy in terms of the recovery and the fiscal consolidation that we've been waiting for the last couple of years. Obviously, a couple of events, as you highlighted, the Russia-Ukraine crisis, which has been a pretty tough blow with respect to supply chain, energy prices, food prices. And I think that's sort of obviously impacted both from a growth and inflation standpoint. And then we've had the, China's COVID stance currently, which has obviously been very negative for supply chain in China. It's obviously had an inflationary impact, but it's also sort of brought forward this whole discussion about global growth, right? I mean, and Eric touched upon that in his initial remarks. I think what we are seeing right now is this concern where inflation is obviously elevated. And, we had this whole debate about whether it was transitory or permanent. Certainly, it's much more in the permanent camp now, and that clearly is a challenge for policymakers. Asia is a great example. I think Asia, when we look at inflation in Asia, was very low, very benign for most part through the COVID period and even prior to that. And all of a sudden, you are seeing inflation pick up because food prices have gone up, energy prices have gone up. These are large components of the CPI basket for a lot of countries. I mean, great example is Thailand. I mean, Thailand was seeing very low levels of inflation, and all of a sudden, it's well above its target zone for the central bank. So this is an issue for central banks, not just in DM. EM central banks have to respond and respond fast. At the same time, you are seeing growth pressures coming through, which clearly is going to be a challenge because central banks, their primary task right now is obviously to control inflation, but that is a challenge because if you feel that you're significantly behind the curve, you will try to do more, not less, and that obviously brings into question what that means for growth, in the coming years and coming months. So I think that's sort of a delicate balancing act that central banks will have to walk. It's going to be difficult, but I don't think necessarily it's very negative, as Kofi mentioned in the previous panel. I think for EM, this may not necessarily be such a bad thing. For energy producers, certainly, I think this is an opportunity. You will see countries which have done more on the rate hiking cycle, LATAM, parts of Eastern Europe. These are regions could benefit in the local currency trade. And then, of course, in the high yield market, while I think a lot of bad news, it's probably going to be ahead in the months ahead, but a lot of it is also in the price. So it's a question of finding the right pockets within the EM high yield space and sort of allocating there. So I'll stop there. I mean, Moby sort of happy to go into this in more detail later.
Well, actually, Kaushik, you've set things up really very well, because my next question is for Chris. Finisterre has this wealth of emerging markets experience and insight. And I am sure, Chris, that you are very mindful of the political challenges that have resulted in some of the markets you cover as a result of, obviously, the upward price pressure. I think Kaushik was very elegant in his reference to elevated inflation. For some people, it's crushing inflation. And it's disrupted whole governments. I guess Sri Lanka is one of the countries that I'm thinking of. Chris, what has all of this done to valuations? And what can we read from that further out? What would be a bold play if we may take the liberty of getting into talking about how you would be bold in this scenario?
Yeah, look, I think the differentiation theme that we've been talking about, is obviously a huge one. And clearly there are countries that have done that are doing very well. Clearly the commodity exporters, are laughing quite literally all the way to the bank. In terms of where things stand with oil revenues and other commodity revenue streams. And then at the same time, we have those countries that are clearly, in the reciprocally opposite position. And Sri Lanka is a good example. And I think that comes back to the overall point that there has been a huge repricing. And I think we've seen, DM markets are really struggling this year. EM didn't have a particularly good last year either. And so when you say there's, one of the things that we're very focused on right now in terms of the opportunity set, is some of the things that are happening in distressed, where it's not to say that I'm hugely constructive on the outlook for Sri Lanka, but at the same time, there's a lot in the price right now, and at 40 cents on the dollar. We now have, whether or not it lasts for more than a couple of days, it looks like we have the beginnings of a semi-functional government. The negotiations on the technical side with the fund, from everything we're hearing, seem to be going relatively well. So I think, it's not to say that this is a potential rising phoenix, in the near term, but I don't think there's a huge amount of downside at these levels. And so when you look across the space, there are a number of stories that sort of fall into that category, where it does seem like the unrelenting pessimism and the horrible technical backdrop have created dislocations in value.
Thanks for that, Chris. And I want to shift slightly, actually, as we bring in Edwin to the conversation, because I want to focus on sovereign debt. That's your area. The IMF's most recent Global Financial Stability Report has made very sober reading. I'm sure some of you in the room would have seen this and online, reporting that the average ratio of public debt to gross domestic product rose to a record 67% last year in emerging market economies. So, Edwin, which are the countries that are going to weather this situation better than others, would you say?
Just echoing some of the remarks which Chris has made and some of the other speakers already this morning, you really want to hide in countries that either don't have to issue because they're enjoying the windfall that's coming from oil prices, or those which are willing to engage with the IMF or other multilateral creditors, or a combination thereof. Right now, that is the key. Kofi mentioned it, the refi risk that exists in our market. These are now levels which is pretty punitive to issue, and you are arguably issuing for many of these countries at unsustainable levels with double-digit coupons. As long-term investors, we really don't want to see that. So we'd rather see or favor countries where they don't have to issue because of this oil windfall, or this willingness to engage with the IMF The IMF has made it clear they're willing and very open to lending to countries to help them overcome this big global shock that the global economy is facing. I think is really indicative of the fact that they were able to come to a staff level agreement with Lebanon. Lebanon, which is a country that really has a long way to get its act together, but even there, there's been a willingness to engage with the most problematic of sovereign issuers. So the willingness is clearly there from the IMF. So I guess to mention a few countries, we like countries like Ecuador and Angola because of oil prices where they are. Neither of these countries has to issue. They're running twin surpluses, so it's very comfortable. Maybe more controversially and with a little less conviction, places like Argentina, which is actually enjoying the windfall from agriculture prices and energy prices, and also is going to remain engaged with the IMF, kicking and screaming. They will. That marriage of inconvenience will continue. So that does remove some of the tail risk. And then in this time zone or in the EMEA region, there's just a bevy of energy exporters, whether it's Nigeria, Cameroon, Kazakhstan, Oman, et cetera, which are in a very comfortable situation because of where oil prices are. So that's really where we're looking. Look for countries which don't have to issue and can stay on the market, because this simply is not a time where the market is receptive whatsoever to issuance.
So there's actually quite an array of opportunities that you're talking about there, which is quite interesting, because I'm thinking of the immediate term, and let's switch it a little bit to developed markets for a moment, Eric. Main Street is feeling the pain, and I'll give you a personal example. Trying to look at energy prices in countries like the UK, for example, it's a point at which the advisory services has said that the big six in the UK, for example, have dropped out of the market. They're just not offering deals anymore because it's impossible to do. We're at that situation where this Main Street pain is juxtaposed against us talking about opportunity. I mean, is there an end to this in the near term?
Well, I think you make a really valuable point, Manisha, which is that, I think those of us in banking and financial markets get a bit overly used to looking at financial conditions on our Bloomberg screens or whatever it might be. But the reality is that you take the United States, for example, mortgage rates for home financing have gone up by 250 basis points in 5 months. Petrol prices are now, $4.50 a gallon, and we all know what food prices are doing. And so regardless of what our financial conditions indices on the screen says, for the person on the street, these are in some ways disastrous conditions. And for a number of markets, a number of commodities, a number of basic goods, there is no supply at any price. And in some ways, central bank rate hikes are powerless to do anything about that. I mean, 50 basis points from the Federal Reserve is not necessarily going to put more wheat into the open market or more oil into the open market. So I think, when central banks talk about a cost of living crisis, we are truly seeing evidence of that. And I think what the central banks are banking on, no pun intended, is that the combination of these conditions on the ground plus a tightening of monetary conditions will hit demand enough that inflation comes back down. But that's a big bet for the second half of the year. Yeah,
that really does. It really is a big bet. And one of the things I've covered financial news for something like 20 years, but something that I've always been obsessed with is psychology. Where would you say we are when we think about the psychology of in the landscape at the moment?
I think psychology has actually shifted quite dramatically over the last 2 or 3 months. I mean, 3-4 months ago, you heard a lot of talk about inflation, but also a lot of talk about the resilience of consumer and business balance sheets. And I think there was a view that there might be a temporary blip. But then the China lockdowns happened, concerns around China, a number of the crises or near crises conditions that we've been talking about, Sri Lanka as an example, and the fear of others. But I think Chris made a really interesting point earlier, which is that the psychology has shifted so negatively over the last month that there's a lot of bad news in the price in a number of places. And you don't even have to believe magically that things will go back to the way they were. You just have to believe that things get a little bit better from where they are today, and that may present some meaningful opportunities for those willing to take that risk.
Which is exactly why I said, let's go to the low and work off the low, because it feels a little bit like that at the moment. Let me bring back in Edwin, actually. Edwin, one of the reasons I wanted to pick up on this and extend on what Eric was just saying was because I have the opportunity, let's just let the secret out of the bag, to speak to all of my panelists before we engage in these conversations. And Edwin said a really interesting thing on that call about how there was some consternation, Edwin, if I may share it, around the reactionary nature of the central bank responses to various situations that we've endured over the last few months. What would you want to see ideally then?
Well, it's unfortunate that most of the world, pretty much all the world's central banks, whether EM or DM, are indeed reactionary, as you mentioned. There is very much a sense that central banks are chasing their tails because the inflation prints that are coming out are just so eye-wateringly bad. I think the terminology of crushing inflation was used earlier, and for many countries, that is indeed the case. The Central European countries, which are now hit double digits, these are levels which we just haven't seen. So that is really the problem. I don't think, going back to this issue of psychology, we need to get a sense that the central banks have at least caught up with the curve. I don't think there's really a sense that they're ever going to really get ahead of the curve, or that these inflation prints just stop being so awful. So that really, I guess, becomes a function of the reaction function. We know there has been an agricultural response function in place. We've had planters that have come in to increase production, but unfortunately, for those harvests to come in, it's something we will see later on in the year to reduce some of those pressures on food prices. Oil has been quite resilient despite the slowing of global growth. So I think perhaps the potential for relief is not going to be as forthcoming. But it is that delicate balance where we reach the point where it's investors or the markets think, okay, central banks have done enough. It doesn't look like we're going to get higher inflation prints. And by most analyst expectations, the peak inflation should be coming in emerging markets sometime in the third quarter, but we're going to need a few months to corroborate the data that is indeed the case. We may very well have seen the peak already in developed markets, but again, it's probably going to take a couple more months to get that corroboration. When we get to that other side, as Eric mentioned, there are going to be interesting opportunities. And just to echo what Eric said and also what Chris has said, we have very interesting valuations despite all this bad news. Yields on both the GBI and the MBI are now north of 7%. We can see for the first time long-term asset allocators saying, hey, this stuff could be quite useful for me to match my long-term liabilities. We haven't been able to say that about fixed income markets for quite some time. So this is a process of creative destruction. It is painful. It's painful as a long-only real money manager who really can't hedge much of my exposure, but it is going to create opportunities for the brave sometime later this year to step in and to really, as I mentioned, use fixed income and emerging markets again as a useful tool to match those long-term liabilities, something which we really have struggled to do for the past decade.
Actually, Edwin, your positive anticipation of later in the year is quite tangible because we can sense the rough ride that you might have had at the beginning of this year. Kaushik, I want to talk about how emerging markets are going to navigate the impact of sanctions on Russia and also slowing growth in China. What are some of the ramifications in the medium term, and will this actually lead to more diversification, sort of reassessing the choices available?
Absolutely. I think diversification is critical. And I think investors are already very proactively looking at those options. I think the Russia-Ukraine situation perhaps is a little bit easier from a diversification standpoint. I mean, obviously, Russia was a very large portion of various indices, and it's been taken out and I think replaced by other countries within the region. Obviously, GCC has been a big beneficiary of that, other pockets around globally, which have benefited from that. So I think on the Russia-Ukraine situation, I would feel that perhaps from just a diversification and allocation standpoint, clearly it's going to be a big challenge from a physical world standpoint, but from a market standpoint, perhaps it's easier to do. I think the slowing China story is a bigger issue from a market standpoint. It has perhaps bigger implications for emerging markets. I think certainly for Asia, it's very important. But for commodity players and overall emerging markets, I think China is a very important anchor for the market. And I think in the past, China has been a very big source of growth for global markets. Right now, we don't want to see China being obviously a negative growth factor. But we believe that I think obviously right now the zero COVID policy is having a pretty profound impact on China's growth and regional growth. We hope, and as Simon mentioned it at the beginning of this session, at some point they will sort of come to grips with the COVID situation. We are already starting to see numbers actually come down, which is a good sign. But it's the question of opening it up and allowing supply chain to operate better. It's going to be critical. I think once we get past the party Congress, which is later in the year, we do expect the fiscal tap to be turned on more aggressively. We do expect obviously limited action on the monetary policy side and infrastructure. I think infrastructure is going to be a big factor. We've spoken about this in China's context the last few years. Numbers haven't really supported that, but this year Q1 was already quite strong. We had 8.5% pickup in infrastructure versus something in the order of less than 1% last year. So that is already starting to pick up. Certainly a lot of the focus is on sustainable and longer term viable projects. So we'll see how that plays out, but we do expect that second half should support the growth dynamics in China, and that will ultimately start supporting emerging market dynamics as well from a growth perspective.
I don't want to rain on your parade, but I'm going to try. And I'm sure lots of people in the room and online have seen this, and this has gone around on social media, and it is a map of China with all of the ships that are stalled around the coastline. And it's just, I mean, no pun intended, it's a sea of ships on a sea to the extent that you can't see the water. I love your optimism, but at the same time, Chris, let me take it to you. No wonder this has to be a year for the bold and the brave, because there's so much to consider there. Supply chains, which is something we'll cover in other panels later today. But things like this are things we have to keep an eye on, right, Chris?
There's no question. I think it's been a very humbling year to date, and obviously we're not that far into it for all of us. I think we've been all forced to, as someone was saying earlier, in terms of expectations that we came in the year, and then Russia, Ukraine have really changed that profoundly. Both, I mean, clearly in a very micro sense for Russia and Ukraine, but obviously with much bigger implications, certainly as it relates to the existing issues around supply chains and inflation that are playing out. I just think, and this is it's a classic trope, but I mean, it is at the points of greatest despair that opportunity creates itself. And so there's no, I mean, it'd be silly to sort of be a Pollyanna about the sort of sense that the turn is imminent. And yeah, I mean, there's no question. I mean, the supply chains are broken. Commodity markets in a lot of ways are broken. But I mean, I think it's foolish to only think of the negativity. And I do think some of the dislocations here are astonishing. So, does one want to be all in on risk at these levels? No, but I mean, I think we are getting close to levels where you do need to be more constructive rather than not. And I think Edwin made a great point. I mean, it's been hard for fixed income in aggregate, and certainly EM fixed income specifically, to be a meaningful contributor or to make sense in the context of portfolios. But I think one of the things that makes me, again, I mean, cautiously optimistic. Look, EM had a bad year last year. EM is obviously having a torrid year this year. But some of the things that I always laugh when I talk to allocators and people are like, yeah, what you're doing sounds interesting, and I like the idea of 6-7%, but my investors want 12, 14, 20%, right? And clearly the opportunities that people thought were that opportunity for some moment in time. But the return, I mean, you look at ARK, you look at Bitcoin, you look at things that people thought were, a much better alternative to boring assets, and they've been wiped out. So I think, as allocators, and I always think, the most important guy or woman in the room is the real allocator, the person behind the scenes at the large institutions, be they public pension funds or sovereign wealth funds, who's the insurance companies, who sits there and works out, what are the widgets in the portfolio, and we're just widgets. At the end of the day. And I think it's a good widget, but when they have to think about where, and listen, you're getting 7.5% now. You're buying MB at 480. Can I promise you that it's not going to go to 520? Can I promise you that yield's not going to go to 850 if treasuries keep going higher? No, of course I can't promise any of that. But I think one of the most important things to remember, one of the things that's always served me well over the course of my investing career, is there's a point at which you're getting paid to wait. And clearly where we were on yields, both in local and in credit, and in treasuries, where you just weren't getting compensated for anything, you're now at points where it's much less obvious that you're not getting compensated. And so when you start looking, I don't want to praise another bank, but Morgan Stanley put out a piece yesterday where they're talking about returns from here. And you don't have to be particularly heroic in your assumptions to think that returns from this point could look positive, meaningfully positive for the balance of the year. And you can afford to have, at 470 on MB, you get 20 basis points of tightening, which doesn't seem ridiculous. It's not a super bullish view. If core treasury yields begin to balance out here, the carry starts mattering. And that's one of the things I think in fixed income that we've forgotten is that this is a massively positive carry asset class again, and certainly in the M debt space. And so people need income. And and those income numbers give you now again some comfort versus capital.
Yeah, let's go down this fixed income route a little bit further. I bring it back to you, Eric, for a moment. We've had a question. I deem this panel a success because we have your involvement, everyone. That's wonderful. So we're hearing, this is the question. We're now hearing about people speaking of a potential US recession. Do you see that as likely, and might the Fed take a U-turn on rates? And the reason I'm posing you this question now, because I think we should also weave treasuries into this part of the conversation.
Yeah, sure. Look, I address the elephant in the room first, which is no, we do not anticipate a U.S. recession. For some of the reasons and themes we talked about earlier, yes, there are some headwinds to growth and some headwinds to the consumer, small businesses, et cetera. And that's from elevated food and energy prices, a surge in mortgage financing rates, et cetera. So I think we will see a deceleration in growth. And maybe the unemployment rate goes from 3.6% to, 4.5%. Is a 4.5% unemployment rate in the U.S. still pretty good news? Absolutely. Is it a recession? No. But you could see an easing off. For Treasury yields, look, our view is that at 3% or thereabouts in the 10-year Treasury, you're starting to approach some decent value. There's a lot of rate hikes priced in over the course of the next 12 to 18 months. And if the Fed even dials that back ever so slightly, maybe they do 25 basis point rate hikes instead of 50, or maybe they pause completely for a couple of meetings. As Chris said, just the stability in rates at a potentially elevated level is really important. And I just wanted to touch on something that Edwin said. If you think about Latin America, the central banks there were very early and in some cases fairly aggressive with their rate hikes. They have injected a fair amount of risk premia and term premia into their yield curves, and you're getting paid quite a bit now to take that risk. So I think people will start to dip their toes in ever so slightly, but they are going to go in search of that higher yield.
Yeah, actually, let's take it on that point back to Edwin. Because Edwin, you shared with us your positivity about sort of the latter half of the year. Perhaps you can extend on this and just talk about some of your expectations. And, amongst all of this, where do you see the reason for most positivity?
Yeah, that's a great baton pass from Eric going to Latin America, because that is the region where we do see a couple good candidates for some of the earliest pausers or ends to the rate tightening cycle. So Brazil and Chile, for instance, they're probably 1 or 2 MPCs away from finishing the rate tightening cycles, and these have been aggressive rate tightening cycles. They've had to be, because inflation is way above target. But we think we're getting very close to job done in those countries. So we do think that there is going to be value in Latin America, and particularly those areas, in those 2 countries. Uruguay is another country we've continued to stay long. And there's also the ability to play inflation linkers in many of these countries. So Uruguay has a healthy inflation linker market, so that's been a good place to be still long rates, but defensively positioned. So yeah, Latin America, I think, is an area where we will definitely will find some of the best value early on. Central Europe, probably a little too early, but we are doing the groundwork. One of my colleagues, one of the first investor trips we're doing again is this week. One of my colleagues is doing a round trip around Central Europe. It's been more than 2 years since we've been on the road, so it's nice to get out there again and to kick the tires. We've been all doing these virtual conferences, and yes, they've been great. It's been great to continue to speak to policymakers, but when you speak to policymakers, you get the official view. It's great to get on the ground again, and I'm sure Chris will echo this, to really start kicking the tires and getting the non-official view and seeing things for ourselves. So that is what we're really looking forward in the post-pandemic world, to identify where those opportunities are going to lie. Latin America, this seems to be the first area, but I think even later on this year, Central Europe, we have yields here which we haven't seen in nearly 20 years. So I think it's definitely worth an investigation. Probably a little early right here and now, but something maybe to look at later on this year.
Yeah, definitely. And actually, I really like this point you make about the difference it makes when you are out and about and you are meeting and you're having the important conversations, but you're also having the backstage conversations, which is often where things get done. So I think that's a great point. I want to bring it back to Chris for a moment, though. Chris, I'm going to push a little bit more here, because I know that in our previous calls, we've talked about a lot of the political ramifications of the change that we've seen. We already talked a little bit about this. But, we're living in a world in which we're witnessing governments willing to ban exports to control wheat, palm oil supplies. Where does this kind of thing end? And what is the implication of this if we start seeing an acceleration in this kind of reaction to disruption?
It's a great question. It was funny when Kofi was being asked if there's anything to be bullish about. I mean, I personally believe that one of the most bullish outcomes that we've seen year to date is the reinvigoration of the Western Alliance. But I think that is, we are clearly seeing, a further, or we had, in addition to the great fixed income rally of the last 40 years, I mean, which is part and parcel of the great globalization story, which then, of course, fed into sort of those disinflationary pressures. To say all of it is over is probably over dramatizing it, but we're certainly at a point of breakage. And I think it's interesting in the sense we're talking about the reaction. There was a question earlier about the reaction of emerging markets to the situation in Ukraine and Russia, and clearly the most amazing takeaway has actually been the complete refusal to throw in behind the West, which has implications of its own. But the Indians have been buying Russian crude aggressively. And so, there's, I think it's been difficult for emerging market, for very few emerging market economies polities have wanted to be clear on where they stand. And there's obviously some very good reasons for that. So I think, unfortunately, there is undoubtedly a beggar thy neighbor dynamic at play. We saw it with, you mentioned the Indians and wheat exports. We saw it with the Indonesians on palm oil. People are acutely focused on trying to minimize the damage, or political leaders are acutely focused on trying to minimize the damage to their domestic populations. And that leads to, it's leading in many cases to bad policy decisions. We see the new government in Pakistan is so desperately committed to the old government in Pakistan's bad policy around fuel subsidies. But I think where we're going to see a breaking point is the realization, and Edwin made this point very clearly, and I think this IMF wants to help. Kristalina is herself obviously Bulgarian. She's had a history not as a central banker or an IMF functionary, but as a World Bank employee. And therefore, I think really does live and breathe the poverty eradication, the poverty alleviation message. And so I think this fund wants to help, but what we're seeing is that this fund wants to help people who want to be helped. And so, I think we're seeing it, well, the verdict is still out in Egypt and Tunisia, but the fund is definitely there. The fund was there, of course, in Sri Lanka, and the Sri Lankans refused to engage positively. But I think that's, again, one of those things that makes me, at the margin, there's scope for positivity, is the recognition, certainly at the IMF and the other organizations, that there's work that needs to be done. The idea of the SDR sharing has somewhat been overshadowed by developments with Ukraine, but therein that was and is a huge source of potential additional capital to support the less wealthy countries in the world. The SDR allocation was clearly a big mover last year and helped a lot of people from a short-term liquidity perspective, but the delta, the vast majority of the new SDRs were given to rich countries. And so some methodology to recycle those SDRs that were allocated to the countries that don't need them provides some comfort. So yeah, I think, look, it's as I said, the deglobalization and is clearly a factor here that's a negative factor. There's no doubt about that. And I think we will see, this is a whole point about sort of people reassessing supply chains, new supply chains being created, the whole friendshoring, reshoring. This is a process that needs to play out. But I think it's early days, but I often feel that some of these things that, again, going back to my point about peak pessimism, that I do take, there will be beneficiaries in this process.
Thank you very much. I mean, that's such interesting food for thought there. And what is actually making me feel very curious is we've talked a lot about emerging markets, but and well done, audience and our audience online, because I'm getting more and more questions. And it's very interesting that a lot of the questions are all about the US. In fact, all of them so far are about the US. Eric, we're just going to pivot a little bit here and talk about this. So one of them here is, if US unemployment increases, can you see a further softening of the equity and bond market? I mean, this is, it's one of those core questions that we often get in panels like this, but it's very relevant.
Well, first point that's worth making is, in many ways, of all of the economic indicators that we pay attention to, the labor market tends to be a lagging indicator. So it's not necessarily what you want to look to as kind of a great crystal ball. It tells you in some ways what you already know is happening. And if we were to see an increase in the unemployment rate, almost by definition, you would also expect to be seeing a decline in corporate revenues and a decline in retail spending. Now, I don't think the Fed would like to say this too loudly and too publicly, but effectively what they're trying to do with this tightening cycle is engineer a bit of softness back into the economy, a little bit of slack into the labor market, a little bit of a softness in consumer spending. So I think in some ways the equity market correction that we've already seen reflects part of that. And we've seen that in both developed and emerging equities this year. And it's not just the technology space. I think if you were to see meaningful softening in the labor market, you would have to believe that broader economic conditions would be reflective of an overall softening in the economy. And in that respect, I think the S&P probably has more downside, and that sort of fits into our view that long-term Treasury yields in the U.S. are probably capped around here as well.
Okay. We've also had a question on dollar strength. Could you detail the impact of dollar strength as well as the base effect on the U.S. consumer inflation outlook to September? Very specific question here.
But I might try and broaden that out a little bit, and I think certainly Kaushik and Chris and Edwin will have views on this as well. historically, people would say dollar strength is a tightening of conditions for the U.S. economy. But what I think we all know is that dollar strength, especially at the levels that we've gotten to today, is a headwind for emerging market economies as well. And it almost doesn't matter if you're a commodity importer or not. Dollar strength at current levels is a real risk for emerging market borrowers, those trying to tap capital markets. I think it is, in some ways, almost as big of a risk for financial conditions as some of the other factors and topics that we've been discussing today. Our view is that the dollar is overvalued. Our view is that at some point, probably later in the year, the dollar will start to soften again as some of the conditions that we've been discussing play out. But calling that absolute peak in the dollar is difficult. But I will say, and I think my peers here on the panel would agree, that a path to better emerging market performance this year would be, significantly aided by a weaker dollar from current levels.
Actually, let's get the follow through on that point with Kaushik. For the benefit of those in our audience who need to understand more about this, and our audience online as well, Kaushik, perhaps you could drill down more specific impacts that this dollar strength is having or could have for emerging markets.
No, I think the biggest impact clearly is on EM local currency debt. I think EM local currency debt has two issues right now, in my view. I think firstly, real yields across the board are quite low, and that's primarily a product of inflation. I think unless you see nominal yields adjust a lot more or inflation starts coming down, I think that's a challenge. And I think there it's particularly important in markets where you have not as strong or not sophisticated buyer base onshore. I think Asia actually benefits from having a much stronger buyer base, much more of a structural bid that you get through pension funds regionally and within countries. But internationally, I think you would want to see stronger bid coming both from the domestic side as well as internationally. I think there the nominal yield and the dollar becomes a much bigger factor. And I think as long as the dollar continues to be supported as we are seeing right now, it's a product of risk aversion. It's a product of the U.S. growth story being a little bit stronger than others. I think as that starts to fade, as Eric said, I think you will start seeing EM FX start trading with its own dynamics, much more of its own idiosyncrasies. And I think that'll help EM FX and EM local currency in a much bigger way. We actually thought this year was going to be the year when EM local actually starts performing a lot better. For reasons, obviously, it's changed quite dramatically. But I think when we get towards the end of the year and the US growth story starts to fade somewhat, that again starts to become much more of a factor.
Kaushik, let me keep it with you. I'm going to start to wrap up now because we only have about 5 minutes or so left on this panel, sadly. I want to talk about the most important issue to absolutely everyone in this room and online, wherever you are. It is, of course, climate change, and it is the transition to net zero. I mean, we have to address the fact that this can also be a massive opportunity for emerging markets, this current situation, to accelerate that transition to net zero. We've talked about how the likes of the IMF more than happy to be involved with partnership, collaboration, innovation. This can happen this year. This needs to happen this year.
We are seeing that. In fact, where you are sitting right now in GCC, these countries have been big beneficiaries of higher oil prices. But I think one of them, most of them obviously very central to their theme right now is this whole process of diversifying, moving to more sustainable platforms, investing in those from a longer term perspective. So clearly countries are doing a fair amount. Even China is very much focused on sort of this progress to net zero. We've seen impact from a growth standpoint last year. In China's case, as it started to decarbonize. So that's a very strong ongoing theme. I think from a financing standpoint, it perhaps has taken a little bit of a pause. Pause is perhaps too strong a word. Certainly, I think it's slowed down somewhat versus where we were at the beginning of the year and late last year. But I think once we see market conditions improve, that financing of green bonds, financing of sustainable bonds will start picking up again. And I think you will start seeing, obviously, the progress that these countries have made or are likely to make, again, sort of ramp up and accelerate as we get into the next few years.
Yeah, and let me put that question also to Edwin. Edwin, are you seeing that acceleration at all? Sustainable bonds, the green, the blue, the rainbow. There are so many different titles, but this is a change we need to see, right?
Yeah, absolutely. And we're seeing it increasingly from our client base, particularly in Europe. If you cannot offer some sort of ESG or SDG or the various acronyms product, you're kind of out of the game. You're kind of a dinosaur. And it's not just Europe. Europe is definitely at the forefront, but we see this from Asian investors and increasingly from US investors as well. The US is quite diverse. Naturally, the leaders in ESG type solutions and climate change solutions tend to be on the coasts. But it's only going one way. Growth is quite exponential. As I mentioned, if you don't have the ability and established framework with which to invest and allocate your investors' capital, you're simply out of the game.
A question which I think you're well placed to answer. What are your thoughts on sovereign debt opportunities around China and Southeast Asia? I think that you touched a little bit on this, but this is a region-specific question.
I'd say the opportunity is going to be probably more in local currency, but still a bit early in the sense that Asia has been a bit of a laggard when it comes to the inflation story. So inflation is going to peak last in Asia. Admittedly at lower levels compared to non-Asian emerging markets. But because of where it is in the cycle, I think it's probably a bit too early. And I think we are kind of spoiled for choice for opportunities outside of Asia, which look a bit more attractive at this moment. But I think ultimately, some of the markets like Indonesia local will be interesting. I don't think the central bank there is going to have to do too much. Inflation remains fairly contained in Indonesia, and yields have come up a little bit. But I'd say it's probably the region which I would look to last for opportunities in the next coming months.
Edwin, thank you so much for that. I'm going to have to wrap up the panel, unfortunately. And so I just want to put my brief final question to you, Eric, really to bring everything together. From everything that I've heard, that we've heard, it feels very much that we are at an inflection point, and that we are at this junction of the old way and the new way. I wondered what your thoughts were on this.
Tie in some of the comments that Chris Kaushik and Edwin have made, and also maybe bring in some of the comments from a panel this morning from the theme of GCC infrastructure development. The opportunities in emerging markets are still significant. And for those with a longer-term time horizon, and for those who see the value that is now on display and can maybe start to look through some of the shorter-term challenges. As Edwin mentioned, in Latin America, we are near the end of the rate hiking cycle. In Asia, there are still some terrific growth opportunities if we see stability in China and the rest of the region, especially in ASEAN, starts to pick up again. So there is still a decent amount of liquidity in the system, even with the withdrawal that we are seeing from central banks. And if we can get through the next 6 to 9 months and get some of these food and energy security issues not necessarily resolved, but starting to stabilize, then as Chris has mentioned a few times, the ability to earn significant returns, certainly above and beyond what we'd gotten used to pre-COVID, I think is meaningful. And so there is a path to a much better scenario.
Okay, Eric, thank you very much for wrapping everything up there. Thank you all in the audience as well. I actually have 2 or 3 pages of questions here, but my advice for the next panel is get your questions in early, because if you don't get them in the first 20 minutes, they might not make it. And we have some brilliant questions here on all sorts of things like the greatest alpha opportunities in US dollars, in euro bonds. If you want to, you can get in touch with Eric, you can get in touch with the teams, and you can hear more from them. So many questions here, but please do get them in early for the next panel. Eric, thank you so much. Thank you also to our panel in London. We have Edwin, Kaushik, and Chris. It was great to talk to you all about all the opportunity amidst, I think, what is quite a disrupted world that we live in. Of course, we have another panel that is coming up, so please stay right where you are, because we've got lots more good content, and it's coming up in literally a few minutes, so stay with us. Thank you.